It's these nuances that make a difference. It's understanding that you don't take a little bit here, a little bit there, a little bit from your brokerage account, a little bit from your IRA, a little bit from your Roth, and blend things together and set it and forget it. Set it and forget it's crap. Welcome to How to Retire on Time, a show that answers your retirement questions. Say goodbye to the oversimplified advice that you've heard hundreds of times. This show is all about getting to the nitty gritty so that we can understand truth behind investments, products, and strategies. As always, this show is not financial advice. Do your research, but hey, enjoy the ride. Text your questions to 913-363-1234, and we'll feature them on the show. David, what do we got today?
Hey, Mike, I have most of my retirement savings in my brokerage account. How should I set up my income to also be tax efficient?
So brokerage account is code for you need to understand how long-term capital gains work.
Yeah.
Or even just capital gains in general. Okay, so here's
Start
roughly
there.
how it works. And even dividends. Let's throw in dividends, shall
Okay. Yeah.
we? Dividends you pay taxes on. It's like income. Whether you spend it or you reinvest it, you're going to pay taxes on dividends in your brokerage account.
As
That-
ordinary income or
Yeah.
something else? Yeah.
Yeah, so it can balloon up to become an issue.
Uh,
If you want to know what your dividends are, don't look at your statements. Look at your tax forms, lines 2 and 3. You're going to start to get a peek on the dividends that are coming through. Then you've got your long-term capital or short-term capital gains. So if you sell a position roughly within a year, you're going to pay short-term capital gains. That's your income tax, ordinary income.
oh.
It's going to show up at that higher tax rate.
So if
have
you
to
bought a
pay.
position like in January and you only kept it till July,
Yep.
then you got rid of it. And whatever gains, if you had any.
Yeah, I mean, if you had
That's-
losses, then you're looking at tax loss harvesting, but that's another conversation. So, but if you're selling the profits early on,
Mhm.
you're paying short-term capital gains, which is taxed as income.
Okay.
Okay, that can become cumbersome. If you hold a position for a longer than a year or a year period of time, then you're now in the long-term capital gains realm. How do long-term capital gains work? Right now, it's 0%, 15%, or 20%. Really simple. Unlike your ordinary income tax, you've got the 10%, the 12%, the 22%, all these different tax brackets.
Yeah.
0, which is nice, 15 or 20.
Okay.
All right. So with that understanding, you've got to ask yourself, how are you going to take income with your brokerage account?
Mm-hmm.
Was that the question, just brokerage account, or were there other stuff?
That's it. So yeah, retirement savings. I have most of the retirement savings is in a brokerage. How should I set
Okay.
up my income to be
Okay.
tax efficient?
So yeah, and most of it, so your IRA assets to Roth, that's something to think about later on, do some IRA to Roth conversions, but that's later on. Let's talk about the income here.
All right.
So with the income section, you may want to take more of a Warren Buffett approach and buy long-term positions. Maybe you've got some index funds that you can buy and just hold, but the index funds, maybe it's not just the S&P 500, though that does have a lower dividend. Maybe you're using certain index funds that focus on, let's say, large caps, so large companies
Mm-hmm.
that have a history of taking their profits and buying back their shares instead of paying dividends.
All right.
That creates a growth position with less taxable issues going on.
Okay.
And then for your reservoir, we call it some principal protected accounts, because if the markets go down, you have to be able to take income. Maybe you invest in some buffered ETFs. A buffered ETF, let's say, and these rates will change, but let's say it allows up to 7% of the upside, none of the downside. Okay. And again, that changes. Sometimes you'll get some downside, but the markets have to drop 60% or worse to start losing money. So look at the details here. But you can put a part of your portfolio in a buffered ETF like that, to where if you then take income out, you're only paying long-term capital gains on the gains, not in the whole position. Okay, so
sure.
let me keep going here. Many people miss this. What they'll do is they'll say, well, I've got my Social Security over here, and I've got my my pension over here, and then my brokerage account over here, and I'm trying to maximize my 0%, but there's just no room. Well, what if you would have delayed your Social Security to 70 years old? And what if you would have delayed your pension if you had a pension or something like that? If you could delay your pension, not everyone can do that.
Okay.
And the first couple of years, you're just utilizing long-term capital gains as your income. Now, just think of this for a second. I think it's right now up to like 96,000 or so. If you're married filing jointly, it's taxed at 0.
Oh,
Imagine income about $96,000 of gains. It's not the whole position, but just the gains, the growth of it.
okay.
That's what's taxed at 0%.
Wow.
That's a good deal, right?
It sounds good. Is it too good to be true?
No, that's how the tax code's written.
Oh,
And then if you cross over the threshold, then the dollars that cross over the threshold would then start being taxed at 15%.
I see.
Many people don't fully understand how capital gains work. I'll admit, I did not fully understand it years ago before I really started reading tax code because, it's kind of important.
Mm-hmm.
But the long-term capital gains starts when your ordinary income ends.
Oh,
So if you have $100,000 of, let's say, pension and Social Security income, you're kind of stuck at 15% taxes. That's not really efficient. But if you delayed and grew these other income streams, and then you took income for the first couple of years from your brokerage account, you could have a significant portion of your money coming from a 0% tax bracket, while the other assets. I mean, do you see this coordination of maybe you have a season where you're taking down these assets, and then you kick on the other income streams, and then you have less. I mean, less income needed from the portfolio. You can blend these strategies and time them in different formats so that you're taking advantage of the tax law as it is. And these subtle changes, by the way, can lead to a significant amount of extra money for legacy and or for whatever your charitable intent could be in later on in the future.
Mm.
It's these nuances that make a difference. It's understanding that you don't take a little bit here, a little bit there, a little bit from your brokerage account, a little bit from your IRA, a little bit from your Roth, and blend things together and set it and forget it. Set it and forget it's crap.
All right.
You want to understand how do you get the most out of your money based on their unique tax situations so that maybe in these 2 or 3 years, you're taking your income with this strategy and then you change it over to then a different strategy, but you're utilizing the brackets and the tax code with its loopholes so that you're getting the most out of your money.
All right. Yeah.
And it is, in my opinion, very obvious if you can take some or a large portion of your funds out and not pay taxes and let other stuff grow and then be a higher income stream later. Like that seems to me like a no-brainer.
Sure. And can people figure this out on their own, or are they going to need guidance from an advisor or a CPA? Or
I mean, technically, you could figure it out on your own if you ask the right questions, but you have to know the right questions to ask.
All right.
That's the hard part. ChatGPT is only as good as asking the right questions.
Sure.
Grok is only as good as asking the right questions. And you could say, what questions should I ask that I'm not asking? And even then, the answers are going to give you what is popular to talk about, not necessarily what is right for your specific situation.
Mm-hmm.
I mean, that's why the DIY investor comes to us, says, hey, here's my portfolio. I want to manage things on my own, but I need help understanding how to navigate the tax side of things.
Uh-huh.
That's why people will come in with their millions of dollars and say, look, I sold my business. It's invested in these things. I need to understand how to structure these things. And then for us, it's very easy. I mean, with our flat fee model, hey,
Yeah.
this is how much it costs to do the job. They're used to paying CPAs to do this stuff. It's just CPAs might not be as able to do the investment side because they're not licensed in investments.
Sure.
They may not be as comfortable. I mean, many CPAs are really tax preparers. They're not all tax strategists. That's not speaking down to CPAs. I love CPAs. They're my favorite people to talk to because it's very black and white. But you have to understand the nuance of many layers of tax code. And it's not just tax code. It's understanding how your adjusted gross income and your modified adjusted gross income affect your Social Security and the Social Security taxes, affects your Affordable Care Act and the not supplements, the subsidies
Oh yeah, subsidies,
that
right?
you can get from it if you're
Yeah.
retiring before 65 for Medicare, right?
Mm-hmm.
So you got the Affordable Care Act beforehand. And then how do you get out of paying IRMA, the Medicare surcharges?
Mm-hmm.
So you have to kind of understand how health insurance works, how investments work, how insurance products work, and how taxes work, and how they all affect each other to really do this kind of planning. And the brokerage account is the more touchy account because even if you don't touch the funds, it's creating tax issues.
Unlike an IRA, which can grow tax-free.
Yeah.
Yeah.
IRA grows, and unless you take the income out,
Yeah.
it's not creating tax problems.
Uh-huh.
It could create tax problems in the future, but at least in that year, you can consolidate the tax issues.
Hmm.
So there's a lot of layers of complexity to those who sell a business, those who sell real estate, those who did save outside their 401k in different ways and are trying to figure out how to get the money out efficiently.
Sure.
And just one point here I want to make. We had to build our own planning software out because we couldn't find a software that helped us coordinate what we were going to take and where we were going to take it.
The existing softwares, were they just kind of siloed in their own little...
Based on the demos and the trainings that I took trying to find a good software so we didn't have to. I mean, it's like the joke, why did you write your book? Because I felt like I had to.
Right.
Why did we build our own software out? Why did we build the app Cash Flow and Capital out? Because I couldn't find a healthy, appropriate set of technologies or planned software, or whatever you want to call it, that did the job as I felt it needed to be done.
Right.
I don't believe in product pitches. I don't believe in the oversimplified bit, but there are certain levers you've got to be able to pull, certain knobs you're twisting to get the result that you're looking for, which is a more comprehensive, holistic approach to the investment side of it while acknowledging the tax ramifications. It's tricky. This is tricky stuff. But I mean, did I explain that okay?
Yeah, I think so. I mean, there's a lot to know, and there's so many different avenues to go down, so many different rabbit holes. Right?
Here's something else that I just remember that we don't talk about enough. What's better, paying less in taxes or growing your assets more?
Oh, yes. Is this a trick question? Because emotionally, like, I just want to, somebody, not me personally, but you might want to just, stick it to the government. I want to pay as little as possible just to sort of spite the government. But that might not be the best. Is that am I on the right track here?
Yeah, it's an impossible question. It's not a trick question. It's an impossible question. What are your goals? You might need to keep your tax below a certain threshold for certain reasons, and maybe you don't. You might want to grow your assets and recognize, like Warren Buffett was in some positions he didn't want anymore, so he had to sell. He sold a lot, and it was like a $26.8 billion tax bill.
Yeah, that's right.
So you have to also think about the paradoxical balance between lowering your taxes overall while still making sure you're in good positions to grow your wealth. And sometimes that is a big tax bill, and it stinks for that year. Sometimes you can let things be where they are. Sometimes you can afford a slow transition to a better portfolio. Sometimes you're just in really crappy positions, and you just got to rip off the Band-Aid and move on. So there is a very interesting balance between tax planning and investment management, and you've got to be able to acknowledge both sides because you can't have your cake and eat it too.
Sure.
Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.